Hello everyone, welcome back to my channel. So this video marks the beginning of the week number 71 in this Road to 100k realized return challenge, and the week started in a slightly negative mood. It has been like this ever since pre-market trading began. Apparently the market is going through a period of a bit of probably consolidation after the strong recovery that it took last week, and also apparently it didn't make too much of an impression, the fact that here Nvidia, and this is the news that was announced today, takes a 2 billion stake in Synopsys to accelerate engineering solutions based on artificial intelligence. And also the fact that here, looking at the probabilities of the Fed fund futures, the market is discounting, or apparently is betting even higher or even stronger on a Fed cut, on a Fed rate, on the interest rate cut by the Fed in the next meeting on December the 10th. So apparently, yeah, this did not make much of an impression in the overall market, and that is why the indexes today are mostly trading down. Even so, we have to keep in mind that we are in a situation in which this is the first day of December. Usually, looking back historically, it's usually a good month. December is one of the best months of the year, usually for stocks on a historical basis. And also, despite this, we need to keep in mind that there may be some additional volatility in the first few weeks of December, specifically related to portfolio managers and asset managers doing some turnover, additional turnover in their portfolios, in order to do some tax loss harvesting and other stuff that will make prices move a little bit more either to the upside or to the downside. But and of course this is purely from an historical perspective. Usually this kind of additional turnover of positions slows down in the second half of the month, and then by the second half usually markets trend up higher, liquidity is a little bit lower, and so usually things tend to improve. Even so, and this is an important point to make, if you recall, we had our $53.50 strike call on XLF last week expiring worthless. We opened another position here. Now, because the price opened up negatively and there was some sort of a gap here, let's show up right here, and yes, this is the gap, and so it opened like this, and because the markets were threading down, we simply took the position as soon as possible. Now, of course, because the stock has recovered and is currently at 53.31, 32, our call that we sold is appreciated somewhat, but still we managed to get $22 on this call, which is quite good. If we manage to keep it until maturity, we will be able to get some sort of profit of around 28, almost 29%, even if we call it, if we buy it back, and plus the commissions, we would be around the 27% return annualized, which is quite good given the fact that we are dealing with a low volatility stock, and so this is quite a good premium to get. And at this point, yeah, of course, we are hopeful that the strike will be reached and we are able to sell our shares. At this moment, we still have some buying power left, but there's nothing we can do with it at this point, so we might as well wait and see what's going to happen either today or tomorrow, either when we buy back these calls today or when we or tomorrow, for that matter, or if we let it die at the end of tomorrow and then we enter into another position like this one, a 630 call, if the price stays like this. And this is pretty much it for today. I want to address another point, given the fact that the stock has recovered and the profit from last week, which I mentioned in the previous video, which was around $98 for the week, which is a very low amount compared to the premiums that we collected in the weeks prior. And I got a few questions about whether it would have been better for us to implement a strategy that we did before, specifically selling 0DT options with the strike price, 0DT options, 0DT calls with 10 delta, with a delta 10 calls, 10 delta calls, and I fully understand, of course, what they mean. It would have been a possibility for sure. However, there is a very strong reason for me not to have done it. As I mentioned before, on the last week's video, if you recall, this is something that requires very close attention to what the market is doing. You have to be constantly sitting very close to the screen and logged in at all times, because if prices revert, the chances are you either have to close the position at a loss, or even if you use stop losses, you will be kicked out of the market if the stop loss is reached, and then you have to get back in. And if the market recovers consistently, you are constantly being kicked out of the market at a loss and getting back in and accumulating additional small but consistent losses. And looking at the chart that we have from last week, and here it is, looking at what happened last week, I strongly believe that if we have adopted this strategy, this would have been exactly the case, because looking here, and keep in mind the week commenced, so the week started on the 24th, so when this larger sweep upswing here, for sure at least once or twice we would have been kicked out of the market, and only probably by the third time, by around here, the call would have lost enough value so that this additional gain would not have hit our stop loss. So on Monday, for sure, that strategy would not have been a successful one, and we would have lost money if we have done that. Here, even if we open up another call right around here with this large upswing here, chances are we would have been kicked out of the market at a loss again. And probably here, even though it's very late in the session, the theta is extremely strong. The theta effect is extremely strong. Perhaps could have been offset a bit the gamma effect and the delta, but still, most likely, this would have sent us out of the market again at a loss. On Wednesday, most likely here it would have been the case, even though probably this would have happened only once, but because then the market stayed relatively constant, and so if we have sold a 0DT call here, it would probably held up and we would kept the premium, and the position would have died at the end of the day without any trouble. Now here, this would have been most likely another loss, even if we have here, we sold around here, and at this time, zooming in, even if we have sold a call right around this time, and the position would have stayed, even if we were generous, and generous meaning very conservative on the placement of the strike, with this upswing, even if it did not trigger our stop loss, for sure at the end of the session, at the very end of the session, it would have been this large and strong upswing, or rather quick but strong upswing, would have kicked us out of the market, because the position for sure, if we sell at around 606, if we are at around 616, chances are we would have been either kicked out of the market, or we would be forced to close the position itself to avoid being at a loss and selling the shares at around, I don't know, 619, something like that. So this is a bit more dubious, but still, for sure, on Monday, on Tuesday, and once on Wednesday. Keep in mind this is our only 4 days of trading. For sure, in all of these days, we would have at least once been kicked out of the market at a loss, and then with the premiums that we get after we kicked out once, we are basically playing catch up and trying to save the day. Now, we could not have known at the beginning of the week this would be the market behavior, but this could always happen. And if we knew this situation would happen, the only way we would be able to profit is if we would be able to foresee the future with a crystal ball and see, all right, these are the strikes that matter, and these are the ones that we need to set, but we don't know that at the beginning of a trading day. So I'm very, very happy that we managed to get a small profit with a very conservative strategy, not try to be smarter than the market. We just played our game the best way we could. Yeah, the profit was very small, but it was a very low risk approach, and I still believe that it was the best way to address these market conditions, because otherwise it would have been not only for sure a losing week, but also a week in which the time commitment to see how the market behaves and making sure we put all the trades in necessary as soon as we get out of the market and all that, it would have been a very excruciating week to manage. And so that is the reason why deciding to do things this way was in my view, the best approach. We had a small win, but it was a win rather than shoot for the moon and not getting anywhere. But yeah, this is it. Feel free, of course, to leave your comments about what I said and about the trading day that we are seeing today and over the coming days. For sure, feel free to leave your comments in the comment section down below. I am also available on LinkedIn in case you need to ask me any questions, and of course feel free to like the video and subscribe to the channel, and we'll reconvene at the end of this week. This is a full week, 5 trading days. We'll catch up at the end of the week to see how the trades played out and to close the week number 71 in this challenge, and I'll see you there.